I wanted to get into a little bit what is likely to happen over the coming months as the virus crisis turns into a financial crisis. The two are likely to come on top of each other, but the financial crisis is going to take some time to develop. In fact, it's going to take probably years to work its way through the system. Whether I'm right about money itself breaking or not, the question becomes, what do you look for as things develop in order to see the changes that are likely to happen? It's important to start with some detail on the background of the situation that will tell you how things work. And one of the most important things that has happened in the last 20 years is what we call the carry trade. Now, the carry trade is simply the way in which money moves around the world from one currency to another. And let's back up a little bit to the year 2010. Okay, the US dollar, this one right here, Federal Reserve Bank of San Francisco, was carrying an interest rate of about 0%. The Federal Reserve set that rate. At the same time, the Chinese renminbi had a rate of about 8% by the central banks in China. Now, that's a pretty substantial difference. And you look at it, you make a fair amount of money borrowing money in dollars and loaning it out in renminbi. This is the origin of all of the problems we have today. And it's how the Federal Reserve Bank of the United States became the de facto central bank of the entire planet. Let me explain. So you borrow money in US dollars and you loan it out in renminbi. Now, this is called the carry trade. And it's called that because, well, a carry is simply an underlying asset that you have, and you're doing a trade. This is really a foreign exchange swap. It's not intended as a loan. The loan is nice because you have an income for your exchange, but the point of it is to move from one currency to another. The idea being that renminbi is only going to increase in value because of their high interest rates. Renminbi are hard to get. There's a market for everything, supply and demand, lower supply because of higher interest rates. Therefore, it's only going to appreciate in value. You want to swap dollars for renminbi on a bet that renminbi is going to increase. And by the way, this is the Chinese yuan renminbi. The people's currency is what it means. The yuan is the traditional name for it. Sometimes you see it abbreviated CYR for Chinese yuan renminbi, sometimes just RMB, but it's the people's currency. So the idea of a carry trade is simply a currency swap, a foreign exchange play. But it also has this loan on top of it. The loan is somewhat incidental to the whole thing, though. That explains a bit of the cavalier attitude. So, how much of this went on? Well, during the time when US interest rates were zero and Chinese interest rates were significantly higher, a lot of it went on. Now, the Federal Reserve did their best to put as much money into the economy as possible. But it wound up going into China looking for more opportunities. I mean, the whole idea of all of the quantitative easing and the zero interest rates and all that was to, get the US economy going and all that. But the money found its way to China instead through this carry trade. How big was the carry trade? Well, this is where things get interesting. You see, the US has a total debt of around $80 trillion. And I'm going to use some really round figures because some of this is mushy. We know for a fact what the exact number is in the United States, but in China, good information is hard to come by. The 80 trillion in total debt in the US, that is federal, state, corporate, personal, is about 4 times the gross domestic product. In China, however, they have a debt of about $120 trillion. And this is about 8 times the gross domestic product. That seems pretty hard to justify. Yes, but the US was hardly growing at the time and has been barely growing, whereas China's been going 6 to 8% a year forever, right? So it sort of makes sense if you look at it that way. If you can justify 4 times gross domestic product in the US, why not 8 times in China? If it seems excessive to you, I agree, but that's the thinking. So, how does this money come into China? Well, you basically have a foreign exchange. The renminbi is currently 7 to 1. This 10 renminbi note is worth about a buck 42. And it, it's really a foreign currency exchange. Now, of that $120 trillion in Chinese debt, how much of it came in through the carry trade? This is what we don't know for a fact. But the answer is a lot of it. Many estimates are about half. Why don't we know? Well, first of all, it's China. We have trouble getting good information out. Second of all, the way this works is that banks often loan to other banks. And you can see this go through. One US bank loans to another US bank, loans to another US bank, makes a loan to a bank in Hong Kong, makes a loan to the People's Republic of China. At some point, it crosses over. Of that Chinese debt, we don't know exactly how much of it is ultimately dollar denominated because it might go back several steps, and it's very hard to keep track of. But one thing very interesting happened in China. Remember, this is an authoritarian government that likes to keep control over everything, not just information, but especially money. The People's Republic of China doesn't really like banks. Well, who does? But they have their own Chinese Communist Party solution to the problem, and that is that they highly regulate and, in fact, own most of the banking in China. There are these 8 major banks that really control absolutely everything. If you're a small business owner in China, it is very difficult to get a loan. Extremely difficult. In fact, this is one of the main reasons why China has its high savings rate. There are a lot of reasons why it does, but if you want to have a big ticket purchase, like a car or something, it's very difficult to get personal credit. You pretty much have to pay cash, which is what most people do. So when you might read that China has a 40% savings rate. Yes, they do, but a lot of that gets spent on big ticket items. So what is the savings rate really? It might be as high as 20%. But they also don't have, for many people, a pension system like we have Social Security in the developed world, in the United States. And they also, when you go to a doctor, you're expected to pay cash up front. You might get reimbursed by insurance if you have it, but that comes later. And given the Chinese structure of families working together, families pooling their resources, very high degree of family values, everybody looks out for each other, everybody in the family is expected to have a pool of cash. In a time of a real crisis, it might come together to give uncle the heart surgery he needs, but hopefully it will come back later. So there's a lot of self-financing going on, and small businesses are no different. The difference is, though, however, that small businesses often go to what's called the shadow banking industry. This is shadow banking means borrowing money from a non-bank, like say store credit here in the United States. In China, there is a network of people who are willing to loan you money. Now, it starts out as US dollars and they develop pools of money, but eventually becomes renminbi, which can be loaned out. You might be able to borrow this, well, not at zero, nobody gets Federal Reserve rates, but let's say you borrow at 4 or 5%, whatever, and then the next person borrows it at 6, 7, whatever. There's a little bit of vig on top of everything that adds up. By the time it gets to the small business in China, it's typically like 20%. Now, if that sounds like loan sharking, well, yeah. Now, the government of China has wanted to crack down on this because they like to keep control. Notice a pattern. And a lot has been done about shadow banking, but this is how finance is done in China. Okay? They don't really have a banking system like the rest of the developed world, so they depend on the United States to do a lot of its financing. Much of it goes through Hong Kong. So, okay, this is how we wound up with an enormous carry trade. And the estimate is that it's about $60 trillion, about half of the total Chinese debt. It might be more, it might be less. No one really knows for sure. But what's important is that the total US exposure to China is similar in magnitude to the total U.S. exposure to the U.S. economy itself. If China breaks, we have a problem. That means that there are a whole lot of defaults that come through the system and work their way eventually back through that chain, and it will take months for that to happen, should it all break. But the total potential exposure is huge. Now, that could cause a lot of bank failures and issues and things like that. A lot of this too big to fail, where we have public bailout. I mean, how much are the people of the United States potentially on the hook? Well, if you look at the Greek default, was a good example. When Greece defaulted on a lot of its sovereign debt, you might have read that there was a haircut or a little bit off the top that was taken. You know, each bank has to take its hit. There was a lot more than a little off the top on the Greek debt. In fact, much of it was defaulted down to about 92%. Remember, there's that 8% that banks are required to keep in reserve. The 8% became kind of a good figure for public bailout. 8% of $60 trillion would be, what, 5 trillion that the people of the United States could be potentially on the hook for if China completely collapsed tomorrow. What are the odds of China completely collapsing? Well, remember, this is all about the flow of dollars in and out of China, because renminbi is not really a convertible currency. Yes, it's 7-to-1, but this is supported by the government of China. All right? China gets in a tremendous number of dollars through what? Trade deficits with the United States. But a lot of that money comes back to the United States and is reinvested in property here in San Francisco, for example, or property in Detroit, or U.S. stocks, U.S. bonds. And it winds up coming back into the U.S. financial system, and much of it leaks back out to the carry trade, back to China. There's a constant flow of money going back and forth, one way or the other. If that breaks, the whole system potentially breaks. And it really comes down to how much China has of these things, the world standard currency. Now, China has a tremendous trade surplus with the United States, but overall, its trade might be well balanced. Remember, all of the raw materials that it buys, like oil, iron ore, etc., are priced in US dollars, no matter where they come from. And it seems that the total net flow of dollars, not counting the capital exchange, has been about even for China lately. Now, in this process, you have to ask yourself, how much are you buying of various goods and goods at, say, Walmart or whatever? All those things that are made in China. What has happened to your personal expenditures? It's gone down, right? When China closed down in February, we saw about an 18% swing from a positive 6% to a negative 12% in April. That's the first number to keep in track of. This was before the rest of the world stopped buying Chinese goods. This is the Chinese internal economy, as people had to stay home in lockdown, etc. The effects of the net cash flow of dollars into China have not been felt yet, so we don't know. But we know it's going to be interrupted. It's at least going to slow down. About 17% of China's gross domestic product is exports. It's huge. We know that their domestic economy already slowed down, and it may stay slower, especially when you talk about people who have a high savings rate to start with. I mean, keep in mind, everybody over 40 in China remembers a time when they were starving, when food was rationed, etc. They're going to be very, very careful. If you think you're being careful about your expenditures, it's only going to be more so in China. So the domestic economy is slowing down, and we can expect that the net swap between these two is going to slow down dramatically too. How much? We don't know. Is it enough to break China? I mean, after all, they were counting on this growth going on forever. That's why you do a foreign currency swap. The idea is in the carry trade that the renminbi will only increase in value, but it actually has been somewhat dropping, especially with this trade war that's been going on. I mean, the best thing that China can do is to keep its goods that they're selling a little bit cheaper by what? Lowering renminbi, making renminbi a little bit cheaper, but that sort of offsets the tariffs. So renminbi at 7 is something to watch for. 7.1 as of today. Where could it actually go? Well, the government wants to control everything. It's sort of what they do. Can they keep renminbi at 7? I'll give you a little note. In order to defend it, it's not like it's traded a whole lot. It goes through the carry trade, but the government sort of sets the rate that goes on. In order to defend that, they need to keep a reserve of hard foreign currency. Back in 2014, the International Monetary Fund started to question how much foreign reserves China had. And they said, well, what's the point at which you get nervous? The answer was about $2 trillion in foreign reserves would be the point where we get nervous. Oh, okay. If you look up the People's Republic's foreign currency reserves today, you'll see that it's $2 trillion. And it has been since 2014. That's the number they tell you. Okay. Can they defend renminbi? I don't know. What we do know is that a tremendous number of things have broken, and the net flow of all of this money has been interrupted. We also know that China was financed at least half through the United States, partly because they don't have a banking system that allows them to do this themselves. It's very, very tightly controlled. When the flow of dollars into China breaks, what happens to renminbi? It's something to keep an eye on. 7.1 today, but if this goes to 8 or 9 or whatever, suddenly all of those loans, I mean, renminbi at 8, all of the loans that were taken out at 7 are now 14% more expensive at a time of economic crisis. If it goes to 9, they're 28% more expensive. I mean, it takes more renminbi to pay off the dollars. At some point, you see a lot of default working its way through the chain. We don't know exactly how big it is. We have a reasonable guess that it's, as I said, similar in magnitude to the US exposure to its own economy. And it's a big, big number. It's not all going to default, but a lot of it could. That's what to watch for, because if renminbi breaks way north of 7, we have a problem developing. And it's something to keep an eye on, because the carry trade is what has made it possible for China to get anywhere. The conversion of US dollars into Chinese yuan renminbi. What will happen to it in the future? We have to keep our eyes open. The potential exposure for people in the developed world, particularly the United States, the central bank of the planet, is very, very large. That's what we have to keep an eye out for.